Every time you exchange one currency for another, you're participating in the world's largest financial market. Not stocks, not houses, not gold, currencies. The Forex market is where trillions of dollars are exchanged every single day, making it the largest financial market in the world. But despite its size, most people have no idea how it actually works. So in the next few minutes, here's everything you need to know about the Forex market. Forex stands for foreign exchange. It's simply the process of exchanging one currency for another. For example, imagine you're an Australian traveling to America. You exchange Australian dollars for US dollars. Congratulations, you've just participated in the Forex market. But the Forex market isn't just used by travelers. Businesses use it, banks use it, governments use it, and traders use it to try and make money from changes in currency prices. Currencies constantly move in value because of supply and demand. Think about it this way. If more people want US dollars than Australian dollars, the value of the US dollar rises compared to the Australian dollar. If demand shifts the other way, the Australian dollar rises instead. These changes happen because of things like interest rates, inflation, economic growth, employment figures, political events, and sometimes simply investor confidence. Every piece of economic news has the potential to move currencies. Here's where Forex gets a little different from investing in stocks. Currencies are always traded in pairs. You aren't buying a currency by itself. You're buying one currency while selling another. For example, the Australian dollar and US dollar pair is called AUD/USD. If AUD/USD is trading at 0.65, it means one Australian dollar is worth 65 US cents. When you trade Forex, you're essentially making a prediction about which currency will perform better. Will the Australian dollar strengthen? Or will the US dollar strengthen? That's what you're trading. Let's use an example. Imagine AUD/USD is trading at 0.65. You believe the Australian economy is improving and expect the Australian dollar to rise, so you buy the pair. A few days later, it rises to 0.67. The Australian dollar is now worth more compared to the US dollar. You close the trade and make a profit. But of course, currencies don't always move in your favor. If the pair had fallen instead, you would have lost money. Forex trading is simply trying to profit from these movements in exchange rates. The Forex market is absolutely enormous. Trillions of dollars change hands every single day. It's much larger than any stock exchange on Earth. And because of its size, the market is incredibly liquid. That simply means there are usually buyers and sellers available at almost any moment. You don't have to wait for someone to come along and buy your position. Trades can usually be opened and closed almost instantly. Another thing that makes Forex unique is that it trades 24 hours a day during the working week. As one financial center closes, another one opens. Trading moves around the globe, from Sydney to Tokyo to London to New York. Because of this, Forex trading is available almost all the time from Monday to Friday. For some traders, that's appealing. But it can also become a trap, because there is always another opportunity. And that can encourage people to trade far more than they should. Now we need to talk about one of the most important concepts in Forex: leverage. Leverage allows traders to control a large position with a relatively small amount of money. Imagine having $1,000. A broker might allow you to control a position worth $10,000, or even much more. This can magnify profits. A small movement in the market can create a large gain. But here's the problem. It also magnifies losses. A small move against you can wipe out a significant portion of your account. And this is why many new Forex traders lose money. Not because they don't understand charts, but because they underestimate risk. Leverage is powerful, but it's also dangerous. Currencies often move sharply around major economic announcements. Things like interest rate decisions, inflation reports, employment numbers, and central bank announcements. For example, if a country's central bank raises interest rates, investors may become more interested in holding that currency because higher interest rates can offer better returns. Demand increases, and the currency may rise. This is why Forex traders pay extremely close attention to economic news. This is where Forex differs from long-term investing. Most Forex traders are attempting to profit from relatively short-term movements, hours, days, or weeks. They're usually not buying currencies and holding them for decades. And unlike investing in businesses through shares, currencies themselves don't produce profits. They don't invent products. They don't earn revenue. They don't pay dividends. Their values simply move relative to one another. That's why Forex is generally considered trading rather than investing. Can money be made trading Forex? Absolutely. People do it successfully. But it isn't easy. The combination of leverage, constant market access, and rapidly changing prices makes Forex one of the most difficult markets to master. Many beginners are attracted by social media videos showing massive profits. But those videos rarely show the losses, or the years it took to develop the skills. The reality is that risk management often matters more than finding the perfect trade. The Forex market is simply the global exchange of currencies. Currencies move because of supply and demand. They are traded in pairs. Traders try to profit from changes in exchange rates. The market operates almost 24 hours a day, and leverage can amplify both gains and losses. Understanding these basics won't make you a successful Forex trader overnight, but it will help you understand what the Forex market actually is, and why the world's largest financial market attracts millions of participants every single day. Because in Forex, you're not buying companies. You're trading the value of money itself.